The Bank of England, after Brexit and after Mark Carney, the head of the city watchdog, Andrew Bailey, has been chosen to succeed Carney as governor. A Financial Times report says that Chancellor Sajid Javid could reveal the appointment later today. Before joining the Financial Conduct Authority, Bailey worked as deputy governor and chief cashier at the BOE. Joining us now is Guy Stear, head of fixed income research at Societe Generale. Great to have you with us today, Guy.
Thank you for inviting me.
No worries. Let's address the Bank of England first of all, looking into 2020. What would somebody like Andrew Bailey, with sort of the experience of dealing with financial stability risks and really a very strong academic record, mean for you looking at the UK, looking at UK corporates?
Well, I think on the one hand, it's very much a vote for stability in that we have someone who knows the institution incredibly well and, as you say, has a very strong academic background and a very strong policy-making background. But I think anybody in this seat is going to be sort of dictated to by events. You talked about Brexit at the beginning of your show, and I think it's going to be very much seeing not only how the UK economy and Brexit evolves, but also how it evolves in the context of a global economy, which we think will be somewhat more gloomy next year.
Yeah, and yesterday, of course, the Bank of England stood pat, but we still got two dissenters voting for a rate cut. So given your view on the UK and the global economy, are we looking at a BOE in 2020 that's skewed towards an easing bias?
I think the BOE will be the first central bank to have to ease in 2020, yes.
Okay.
Because I think that they will be dealing not only with a weaker global economy, but also with the fact that they're probably a little bit behind the curve relative to other central banks, given that they've had Brexit uncertainty. And finally, that they do have the immediate Brexit challenge. We'll see how that goes, but I think the near-term impact in terms of Brexit will probably continue to be a bit of a drag on the UK economy.
The thing is, though, Guy, the counter-side to that argument is that we've had the uncertainty over Brexit for 3 years, and arguably some of that has now dissipated now that we know we are going to exit the EU on January 31st, if all goes well for Boris Johnson, bringing the withdrawal bill to Parliament today and expecting that to push through with his huge 80-seat majority. Yes, there's still the trade agreement to be worked out, but surely some of the uncertainty has gone away, and maybe actually the argument is the Bank of England should just be on hold.
Well, I think in the near term, the Bank of England will be on hold, but I think we've replaced one kind of political uncertainty as to when and will we get a deal done with a more economic uncertainty, which is what is the actual impact in terms of that deal when we start to see it feed through. It's not just the trade deal with Europe itself, it's all Europe's trade deals with the rest of the world that the UK still has to replace. That's an enormous amount of work. They're honest about that it's an enormous amount of work. They're optimistic about how quickly they can get it done. I think most other people are less optimistic about how quickly these kind of deals can be forged. So what we really don't know is what, once Brexit does start, because it hasn't started yet, what the impact on the UK economy will be.
So when does the market actually start to worry about what you're talking about? Does it start to worry in the third or fourth quarter of 2020, or does the market start to price those worries at the start of next year?
Well, to some extent, those worries are being priced in already because people are reflecting those concerns at the moment, saying what kind of a Brexit are we going to get? It's probably a harder Brexit today, or people's expectations are for a harder Brexit today than they might have been, say, a week ago. There was a lot of uncertainty after the Conservative elections about whether the Conservative majority would mean potentially a softer Brexit or pulling back from Brexit. Now it seems we're more dead set on the hard Brexit. I think the real proof of the pudding will be seeing when the data comes in over the course of next year, and that's what the Bank of England is really going to have to react to.
Yeah, and also in terms of the government plans, because of course this week we're going to get the withdrawal agreement bill, but there's also a host of other bills, 26 in total, including spending on the NHS and other areas, infrastructure, just one of them, for example. So with this government, I mean, when I was standing outside 10 Downing Street, Sajid Javid came out and said, "Welcome to the people's government." We mustn't necessarily expect a huge opening of the fiscal taps, but it is the end of austerity. So what does that mean to you, who looks at fixed income, gilts, and also credit in the UK? How would you be looking to position ahead of a government that is willing to spend a bit more?
Well, I think in the very near term, the question is, they will open the fiscal taps, but how are they going to pay for it? And I think borrowing is the answer. So in the interim, we're going to see more gilt supply. On the flip side, though, the real question, its supply is much less of a driver than what the economic outlook is. So the real question here is whether fiscal expansion is going to offset contraction in terms of trade, uncertainty with trade relationships, the way that the UK trades with the rest of the world, and how the UK replaces the imports that it gets from the rest of the world, or if it does. Where is the pound going to settle? How quickly are we going to see some import substitution in terms of the UK? What are the UK's new changes in terms of trading partners going to be? All these things are tremendously uncertain. So I think you can build a situation for saying, yes, there's going to be fiscal expansion. Yes, there's going to be a lot more gilt issuance as a result, but the economy is going to be weak. So there's going to have to be a lot of easing policy. Therefore, we see a steeper curve. And that's not a good mix in terms of credit quality or corporate quality in the UK either.
All right, so you see a steeper curve then, but in terms of the long end, the 10-year itself, do you expect that to sort of stay where it is or actually fall a little bit because the net effect is that the concern outweighs the fiscal expansion?
Well, I think in the near term, you're still likely to see downward translation in terms of the curve, and you're likely to see the long end come lower because of concerns about growth more globally. The big question, sort of the outstanding question about the UK is in 2, 3, 4 years, what's going on with the pound? What's going on with UK production? What's going on with UK exports and imports? How does the overall economy look? What is UK government credit quality like as a result of that? And these are long-term thorny issues that have to be dealt with.
Yeah, and just briefly, end 2020, is the pound more likely to get to 140 or 120?
I think it's going to be weaker, unfortunately.